Let's start with the topic of money supply and general price levels. So this is quantity theory of money explains the relationship between money supply and general price level. So neutrality of money. It is the theory which states that a change in the quantity of money in the economy will only be affected due to changes in the price levels, but not real variables such as unemployment. So what is quantity theory of money? That is also QTM. So this theory states that that increase in price is caused only by increase in money supply. So that is the price level. So that is the price level is directly proportional to the money supply. QTM can be presented in two forms. First one is equation of changes. This was formulated by an American economist Irving Fisher at this was formulated by an American economist Irving Fisher at Yale University in 1920. So according to the monetarist, V and T are constant in short run. So a change in money supply will cause a direct and proportionate change in the price level. Cash balance equation of Cambridge School. So this theory was formulated by Alfred Marshall at AC Pigou. So M equals to KPT. So K is equal to cash balance at the or the percentage of income people want to hold in the form of money. So K equals to 1 divided by V. So in the short run, both K and T are constant. Therefore, changes in money supply will have a direct and proportional changes in price. That is, M and P are positively related. Velocity of circulation of money. So it is the average number of times a unit of money changes hands over a period of time. This measure is also termed as income velocity of money. What is the importance of velocity in circulation of money? So it indicates the size of the average expenditure generated per unit of money, indicates the value of income for finished goods generated per unit of money. It helps to evaluate for future inflation conditions of the economy. Determinants of velocity of circulation of money. So general price levels, money supply, real output of the economy, and speculation demand of money. So these four points will are the form factor of the velocity of circulation of money. Commercial banks are financial intermediaries which link those have surplus funds and those who have shortage of funds. A commercial bank undertakes money from general public or non-interest bearing demand deposit and interest bearing savings and time deposit and uses this money for lending, investment or other operations. Only commercial banks can maintain demand deposits. Any bank which maintains demand deposit are known as commercial banks. So they have the ability to do credit creation. Commercial banks. Due to profit motive nature of these banks, we call them commercial banks. Joint stock banks. As most of these banks are private companies and have limited liability, we call them joint stock banks. Then there are retail banks. As these banks sell most of the banking services, we call them retail banks. High street banks. As these banks are often found in towns or cities, we call them high street banks. So what are the functions of commercial banks? Primary function and traditional function. So accepting deposit from publics, current account, saving account, fixed and term deposit, providing loans and advances, that is bank loans and advances, bank overdraft. Secondary function, sub-function of a bank is, commercial bank is protecting customer deposit and agency services. So agency services can also be like collecting income from clients on behalf of them and depositing in their accounts. Example, dividends, interest. Making payment on behalf of the customer, like electricity and buy and sell shares. It also acts as a trustee and executor of the property and will of its clients, provides consultancy services for business clients. It also financed foreign trade, like accepting foreign bills of exchange and collecting them from foreign banks, transacts other foreign exchange business and buys and sell foreign currency, provides safely lockers, issues various forms of credit instruments such as check, draft, issue letter of credits, pawning services. So this is the structure of asset and liabilities of a commercial bank. So this is an example balance sheet of a commercial bank. So on the left side, we have capital account, total deposit and total borrowing. Then on the right hand, we have cash in hand, due from central bank, due from domestic bank, cash in the process of collection, foreign currency denominated assets, T-bills, that is treasury bills, treasury bonds, commercial bills, other investments, loans and overdrafts, fixed and other assets. What is the liquidity of commercial banks? So liquidity refers to the existence of sufficient funds to make day-to-day payments of the bank. So cash and other liquid assets which can easily converted into cash are held for this purpose. Sources of funds of commercial banks. Sources of fund, so the composition of funding of licensed commercial banks, that is share of each component in the total resource basis. Uses of funds. Uses of funds, so the resource utilization of commercial banks. Reserves of commercial banks. Reserves indicates the most liquid asset held by a commercial bank. They include cash in hand due from central bank, foreign currency in hand, excess reserves of commercial bank. Excess reserves are the reserve in the excess of required reserve. It is obtained by deducting required reserve from the reserves. What are the financial instruments of a commercial bank? So financial instruments are tradable assets of any kind. They can be cash, evidence of an ownership, interest in an entity of a or a contractual right to receive or deliver cash or another financial instrument. Deposits. Deposits are sums of money placed with a financial institution. Demand deposit, saving deposit, fixed and time deposit. Loans. So a loan is a specified sum of money provided by a lender, usually a financial institution, or to a borrower on condition that is repaid either in installments or all at once on agreed dates and at an agreed rate of interest. What is treasury bills? Treasury bills are government securities that have a maturity period of up to 1 year. Treasury bills are issued by the public debt department of central banks on behalf of the government. What is treasury bills? Treasury bonds. Treasury bonds are medium and long-term government securities and are used in maturities ranging from 2 to 20 years. Agreements. Repurchase agreements, repo, are arrangements which involve the sale for cash of securities, usually government securities, at a specified price with a commitment to repurchase the same or similar securities at a fixed price on a future date. What is a commercial paper? So commercial papers are short-term non-collateral debt securities issued by the private companies to raise funds for their own use by banks or other financial intermediaries. What is corporate bond and debentures? Corporate bonds are medium or long-term securities of private sector companies which obligate the issuer to pay interest and redeem the principal at maturity. Corporate bonds that are not backed by a specific asset are called debentures. Asset-backed securities. So asset-backed securities are bonds collateralized by mortgage, loans or other receivables. So what is financial leases? Financial leases are accommodations provided to finance the purchase of capital or durable equipment in which the legal owner, that is lessor, lends the equipment to the lessee for payment that covers the full principal payment and interest cost. What are shares? Shares are securities representing a portion of the ownership of a company that are a claim on the company's earning and asset. Shareholders are paid dividends, which are a percentage of the profits of the company. Financial derivatives. A financial derivative is a financial instrument that is linked to another specific instrument, indicator, or commodity, and through specific financial risk, such as interest rate risk, exchange rate risk, and equity and commodity price risk, can in their own right be traded in the financial market. So what are regulatory policies and authorities? So monetary policy is the means by which a central bank of Sri Lanka seeks to achieve its objective of price stability by influencing the cost, that is interest rate, and availability of money, that is money supply. This is done through interest rate and credit availability mechanism. So monetary policy framework consists of policy variables, monetary aggregates, institutions, and target and instruments. So these are there are several channels through which policy changes are transmitted through economy. They are interest rate channel, the credit channel, exchange rate channel, the wealth channel, and expectations. And the objectives of or aims of monetary policy is price stability and economic stability, full employment, equality, and economic growth plus development. So those are some in-depth topics of money supply and general price levels. That's it. Thank you.